Hi everyone. So I want to talk about my trade selection process because I know this is probably the most important thing for anyone watching, and this is really was also the biggest thing for me to kind of have a mechanical way of choosing what trades to enter and which ones not to enter. And I guess it's mechanical and dynamic, but I'll give you my reasoning for the two positions that I opened for silver and crude oil, and it was both strangles. And currently they're up combined and unrealized 1.6% on my capital from the beginning of this month. So that's pretty good. And I opened these two trades after the tariffs between Mexico, US, and Canada and US got settled. So basically they both got both countries got to an agreement with the US, and there are no tariffs for the next 30 days or a bit less than 30 days at this point. But basically, I will go over, show you each and every trade, and then obviously I also want to again share my strategy. And I know some of you already seen it, but this is why I'm going to put it at the very end of the video. For now, let's go over the reasoning, and also I will give you an explanation, and I'll show you some trades that I did not enter live. I only opened them on demo account, and I'll give you an update how they go. And so this is basically the crude oil trade. It was opened on February 3rd, so it was a Monday, so right after the month began, after the weekend, 101 days to expiration. We got a really good range, and I'll go over the range on the actual graph right now, but this is just a quick screenshot. This is the position sizing basically that I'm going with, and the fill price that I got, and the stop loss was actually set at 40% to begin with, because the range was such a big range, such a good range. I think this is the best range I've ever gotten on a position, and I'll show you why in a second. But this is for the crude oil position. It's currently up 14.3% of credit, which is pretty remarkable. Take profit is at 50%. So let's go over the reasoning of this position. And before I do, this is my academy. This is something new I kind of started. This is basically where I do one-on-one work with people, like actual one-on-one work, and it's just me. There's no one else, because a lot of people kind of want to learn my process, and it's really tough to I guess teach it through a course. And even though I am working on a course which will be completely free on YouTube, it will be probably like 10 hours, it'll be really detailed. But this is the academy. So if you're interested in I guess doing one-on-one work, and just let me know, email me in the description below. Now, there is no upfront cost for it, so it's basically performance based. So if I do a good job, then we can talk about it, but otherwise it's basically no upfront cost. So let's go over the CL position and see why I opened it on the graph. So first of all, the range was just insane. And one more thing, Canada is exporting a lot of oil to the US. So once I heard that the tariffs are off the table for now, at least, between Canada and the US, it was a good essentially trade that I wanted to get into before, but I did not know how the whole tariff situation will unfold. I have no idea, right? I'm just reacting to what's happening. And once they said everything's gonna be fine, I opened the position. I actually opened it on the evening of Monday, which I guess is representing by this candle, but it was opened on Monday. And as you can see, the range that I got for my short triangle covers the price movement since June of 2023. So it's basically a year and a half. So basically the price was moving within this range for a year and a half. You cannot ask for anything better than that, right? So, and the position is obviously doing quite well. Now, for the volatility, right, because this is really important for us. So if we look at the CVOL, which is the commodity volatility index, and for this specific one, I'm looking at 3 months. So we opened it, it was a Monday, so it was right over here. So basically, CVOL has been pretty flat since December for crude oil. So this is why I felt okay opening the position. It wasn't at the highest point, it wasn't at the lowest point, but overall, this whole range for the volatility, which this will be the highest point, will be the lowest point over here, it's pretty flat. It's not really like much of a swing. And the reason I'm not counting this as the high point is because this is when we had the elections, November 6th, when the volatility started dropping down, when Trump got elected. So basically, this is, like a different period of volatility, and I want to try and do my best and focus on the period that we have right now. and it's hard to know exactly when one period is switching to another. But here it's pretty clear, obviously, that volatility just kept coming down and it just kept coming down to this point, and then it was just gonna go sideways since Trump got elected. So I felt really good opening the position right over here, and because the tariffs war for now is kind of paused, the volatility really came all the way down, which really helped our position. This is why we're up. We were up 15% on Friday today at the highest. Currently, it's closed at 14.3, and it's really quick for a 100 days to expiration position. So this is why I opened this position, and we'll see what's going to happen. Obviously, if the position is still open up until Trump might renew the tariffs, we'll see. I might close the position early. For me, it's all about getting into trades where I know, or at least to the best of my knowledge, there's nothing that can really affect the price of a commodity or the volatility. So crude oil was one of them, up until the end of or the beginning of March for now. So we will see what's going to happen, but for now, this is a really good position, really good range, and we don't have any tariffs, any geopolitical tensions, trade wars going on. At least for now, they're paused. So the second position, the silver position, currently it's up about 6.4% of credit. Also not too bad. This position I also opened with a 40% loss target, not a 50%, because again the range was so big, and I could easily move from 50 to 40% loss, basically without sacrificing like any major amount of range. And this one was open with 113 days to expiration, so it's doing really, really well for just a few days, being up 6.4. And stop loss was not moved yet. On the crude oil, the stop loss was moved to 35% because the position hit 15%. And obviously, as the position is getting better and better, I'm moving my stop losses to make sure that if anything happens, I'm not going to be losing the full amount of the position. And this is from my experience, from my 9 years, this is the only way to go about the stuff, because anything can happen, right? But obviously, but you always want to worry about how you manage the risk. So nothing too special about this position. Really, it was just a good risk to reward with 40% loss, 50% gain. Really good range. Let's go over the range here. The range was also pretty amazing, and I opened this position also on a Monday, which is right here at the evening, but I guess again this candle is representing it. And the range is occupying, or the price has been moving within the range since beginning of September, basically. So we have September, October, November, December, January. So 5 months. 5 months of range is really, really good. And for me, I'm looking for at least 3 months, and this is perfect. 5 months is completely perfect for me, and the position is doing quite well right now. And also silver is more of a precious metal like gold, but it's also pretty industrial. It's being used as an actual, like an actual commodity, as opposed where gold is only, or the majority of gold trading is based not on the supply and demand, but because gold is treated more of a currency, more of a safe haven. So silver is also it has some of its qualities, but it's acting more like copper, which I will talk about in a second, because this is a position I opened up on a demo account and not on a real account due to a few reasons. But silver is acting more like copper because it's an actual commodity that's being used more and more often in many applications of business and life. So this is the range. Now, if you look at the commodity volatility index for silver, so go to the 3 months. And again, I'm not counting what happened when Trump got elected, because this is, volatility was getting up to the election. As you can see, like crude oil, it just completely went all the way down and was basically flat. But here we opened the position on Monday, so you can see the volatility was actually on the high side for the past 3 months, for the past period, I guess, that I'm looking at. And volatility is going to dumb down, which is again really, really good for us. Now, one more thing: the CVOL represents the volatility of the front month of the future, right? And I'm trading with the July month, so this is not the front month. So this is why the volatility is a bit different. Usually these months that have more days to expiration, They are way more stable. They have less volatility fluctuations. But overall, again, good entry. And obviously this is the benchmark that I'm using to enter a position based on the volatility, even though this is just the front month. Now, a position that I wanted to open but didn't open was copper due to a few reasons. So CVOL was good and bad, but I want to talk about the major reason because I feel like it might be a bit problematic for some people. So you can see this is the range that you can get if you skew strangle, and this I opened this demo position on just 2 days ago, basically, as you're watching this video, when the video is actually out, right? And the range is really big, right? So if you see, the last time the price was outside the range was in May 2024, yeah, so about 6 months. So good range, good credit, good DTE. The only issue is Trump put on tariffs on China, and then China put on tariffs on the US, if I'm not mistaken. And China is the biggest single purchaser of copper in the world, right? Copper is needed in basically everything, electronics, real estate, everything, every single thing, right? So the price is going up and up, and I'm just obviously just reading the news, and you can see copper at 3-month high, Chinese buyers return, or US copper premium should rise, national security demand. So you just kind of go through the news, but overall, this is not a position that I would want to open because there's some tensions. There's still the tariffs are still applied to China, so I just don't know how the price will react, and this is not something I want to get into. I guess once they settle the this trade war, if it happens anytime soon or not, then and only then I will look into open a position. Otherwise, this geopolitical tensions is not something that I want to get into because it's completely unpredictable, and obviously we have a neutral position, so it can only hurt us. And just so you know, this position is down 30. It was down about 35% at the peak today. So I just opened it yesterday, and it's already down 35%. Volatility increased. The price shot up, obviously, and this is also a skewed triangle, so it's closer to the top side than the bottom to get that range, right? So this is also why I didn't really want to open, because the skew was too big. Even though I can easily open positions like that, but there were too many factors, and it just did not look like a good like a safe trade to take, really, and I didn't take it. Overall, this is about it for this week. Now I have a video coming out tomorrow about the fundamental analysis of futures, or if you're watching this video at any point in the future, there is a video on the channel for fundamental analysis. So basically everything to do with news, what kind of news are critical and non-critical. So make sure you watch it, because this is exactly what I'm looking at to open a position, and this is basically my process every single time to decide, okay, do I want to open a position? And I guess this is the fundamental process, not the technical, where I select the strikes and the DTE to get to a point where I have this kind of range to my stop losses. Now, this is my strategy. I've gone through it every single video pretty much, and for those of you that are new to the channel, this is basically my strategy. I still short strangles 95% of the time. I can definitely sell some short calls, short puts sometimes, usually not. I try to stay at 45 days or less, but those past few trades have been 100 days to expiration and more, or actually 90 days to expiration and more, if you include last month. And this is basically because the price is just fluctuating quite a bit, so I want to have a good range to my stop losses that covers the price movement over at least a few months. So this is why 45 days to expiration currently just is not the best, but this is where I try to stay if I can, because the theta is the biggest there. It's accelerating the quickest. But you take what the market gives you and you use your tool bag to adjust to what's going on, which currently means for me to use around 100 days to expiration. These are the products that I trade. Now, I usually stay at about delta 20 to 22 for short strangles, and about delta 35 for short calls and short puts, which again, I don't trade that much. My profit target is always 50% of credit, and my loss target generally is 50% of credit, but some trades I can go to 40 to begin with, like I did with crude oil and silver. And my stop losses are dynamic, which means as the position is getting better and better, I'm just going to be lowering my stop losses. Like we went over C-vol, so I always use C-vol for a good entry. So I want to make sure I'm entering when options are relatively overpriced, so I can get a good price when I sell them, and hopefully for C-vol to go down in the coming days or weeks, and I can profit from the options price decrease as well as the theta. I will exit the trades if the targets are hit, the profit target or loss target, or at 21 days to expiration, because I want to avoid basically gamma risk. Barely happens. Usually the trades are closed well before 21 days to expiration, but it's here. I can adjust the position if needed, which is extremely rare. Maybe happened like twice in 9 years or 8 years, I think, or maybe almost 9 years at this point. So this is only if it's something that makes a lot of sense. So it rarely happens, and I can definitely exit early if, for example, we have those tariffs coming up, or things that I can deem as critical news, which can have an unexpected effect on the price and volatility. So no point in risking anything, just getting out of the position and looking for a better entry or just to see what's going to happen. And again, the most important thing, I am looking for a good opportunity where the risk is worth the reward. This is the number one thing for me. I just want to make sure that I'm opening a position where I have the absolutely best profit potential and probability to actually make money on the position. And this is why my win rate is about 93%, which is obviously really, really, really good for my risk to reward. But again, it can mean that I might not have a trade this month. Usually never happens. It can definitely happen. Last year, I had 2 months where I did not have any trades, which is completely fine. Finished the year at 69% profit, which is it's amazing in my opinion. And I traded way less than I did in previous years. And the return was on average actually higher than my average, which is about 51% per year. So it was pretty good. And if you have any questions, obviously let me know, comment below. And if you want to join the academy, just email me and we'll try to make it work. And again, thank you so much, and I will catch you in the next one.